Okay, okay, this is my analysis of Euro USD Wednesday, June 25th. So I'll start off on the monthly chart and mark out the monthly open just for reference. Then I'm going to mark out the April high. This is a monthly chart. Each candle is a month. Okay, I'm marking out the April high because usually when price sweeps highs, it reverses. Like here, price swept the high, reversed, swept the low, reversed. So because price swept the high, it might reverse temporarily in the next few weeks. Then I'll go down to the weekly chart, mark out the weekly open, this week's open. Okay, and then we can see that this week's high that's 2 weeks ago's previous week's high has been swept, has been run above. So again, that means price may reverse to the downside because it swept a high. There's more to that, but all you need to know is basically when a low is swept, price may reverse. When a high is swept, when a low is swept, price may reverse to the upside. When a high is swept, price may reverse to the downside. So, for example, here, price swept as high over here and reversed. Here, price swept as high and reversed. Here, price swept this low and reversed. So it tends to happen even if it is only temporarily. So there's that, okay. And then we look at on the weekly chart, we try to determine a weekly bias, which is basically just where you think price is going to go in the next week. So if we look at the previous week, so this was the last week, week of Monday the 16th. You kind of look at that and think, where's the next week gonna go? So this one's interesting because it's an inside bar, which means that the low of this candle is higher than the low of the previous candle, and the high of this candle is lower than the high of the previous candle. So this candle is totally within the previous candle's range, which means it's an inside bar, which means it's a lot harder to determine a weekly bias. So I'm going to say that my weekly bias would probably be bearish because we swept this high, which tends to mean potential reversal. We swept the high with wicks, which means we swept the high without closing above it. I don't know how much you know about candles, but basically this is a bullish candle, this is the open, this is the close. So this is the close, this is the open, this is the low, and this is the high. So it did go higher and sweep that high, but it didn't close above it, which shows some sort of rejection. And that kind of fits in with my idea of price sweeping a high and then reversing. So it did the same on this week. and it closed bearish. It closed lower than it opened. So it's a down close candle. It's a small down close candle. But again, it wicked above the high. So it went higher, but it came back down and closed below. So it's sort of a rejection. So I would have been thinking that we have a bearish weekly bias. Obviously, that's just something to keep in mind. It doesn't mean we have to go short this week only, but something to keep in mind. Obviously, at this point, it's not looking like a bearish week because this week is obviously looks like a strong bullish candle. But so far we have also now wicked above this high, the high of the week of the 9th of June, and come back down. So that also may indicate a reversal. So we might be looking for shorts today, potentially, because price is very high. Another word for high is premium. So price is very premium. It's pretty much as high as it's been in, like a few years. So it's pretty high. So I mean that's not so relevant on an intraday basis, but it is high, and even relative to the past month, the past 2 weeks, past week, it is high. So we could be thinking about going short. Okay, so go down to the daily chart. Just fix up these lines. Okay, so the daily candle also wicked above this high. So it went higher, but it closed below. So that's like a form of rejection. It's a slight indication of rejection. So we may potentially see that reversal come in today. So I'm gonna say that my daily bias is also bearish. You would think, potentially would think it's bullish because you had a bullish candle followed by a bullish candle. And by the way, grey candles are up close candles and black candles are down close candles. So grey is bullish, black is bearish. I just prefer not to have red and green because it's there's psychological factors that you see red and can upset you. You see green, you get too excited. So I just made them grey and black. So now I need to tell you about fair value gaps, which is very important. So I've got a thing here to show them, but they are quite easy to identify anyway. Basically, a fair value gap is when there's a gap on a candle body. So if you look at this candle, you look at the high of the candle before. So if it's a bullish candle, it can only be a bullish fair value gap. If it's a bearish candle, it can only have a bearish fair value gap. So this can only be a bullish fair value gap. So we look at this candle, we look at the high of the candle before it and the low of the candle after it. So if we look at the high of the candle before it and the low of the candle after it, after this candle, they don't touch. So it leaves this gap in this candle's body. So you can almost see it actually looks like a gap between. So you know, if you take away this candle, there's a gap between these two levels. And that basically indicates inefficient price action, which, well, inefficient price delivery, which basically how you can use that is price can, it will generally return to those levels and potentially react to them. So price can potentially react bullishly to a bullish fair value gap, which we can see has happened here. So price returned to this bullish fair value gap, it went up and returned to the bullish fair value gap and then bounced off it to the upside. Alright, so we use fair value gaps like that. We use fair value gaps as thinking about where price might go. So what I'm going to do here as well is mark out this gap, and because we are looking at the day being bearish potentially, where could price go, right? So one place it could go is to return to this bullish fair value gap, because it's inefficient price action. Price wants to deliver efficiently, so it's going to want to return to there. And it also lines up with the April high, which is interesting. When things line up, it's something to take into consideration. It's a good thing generally when things line up. Okay, so that could potentially be our target for the day, or just basically will, you know, until price reaches there, we're going to continue to be bearish probably. This here is a bullish fair value gap, but it's not formed yet because this candle hasn't closed. This candle can still fill in this gap and reach this candle's high and fill in this gap. So it's not a gap yet. It's only a gap once this candle closes. Okay. So this is the daily chart. We'll also look at market structure. So market structure is basically just, you know, the basic up, down, up, down, up, down. And you've got, you know, breaks of structure. You've got higher lows, higher highs, and then the bearish is obviously it's the opposite, lower highs, lower lows, right? So that's basically what market structure is, but then we have to identify that on a candlestick chart. So as you can see here, price goes up, high, low, high. So obviously at the moment the daily chart is looking bullish. Then you can see price came down here, came up here. So this is like the most recent low, and then this was the most recent high, but it's been broken. So the current market structure is from this low to the current high. Then we mark out the midpoint of that. And the midpoint is called equilibrium. We call it equilibrium. Generally, if price is above equilibrium, it's high or premium, and that means that potentially, well, generally it does want to return to equilibrium. If price is low, below equilibrium, or another word for that is discount, price generally wants to return to equilibrium. So it's like mean reversion theory. Price wants to return to the midpoint. So essentially, to make it simple, if price is high, it wants to, go lower. If things are expensive, eventually they're going to come down. And where's the obvious place for it to come down to at least is the equilibrium point, which is right between expensive and cheap. So yeah. So we look at the midpoint. Price is above it, so it's premium, so it's high. So we could be looking to short, but on an intraday basis, things can be flexible. But it's something we want to keep all the facts in mind. Okay. Then we go to the 4-hour chart. Let's fix up this line. This one. Okay, so if we look at this 4-hour market structure, we can see that price goes lower, higher, lower, higher. Over here, this was the high, but price only closed above it here. So we're going to look at this structure, and this is going to be the 4-hour equilibrium point. So in terms of the 4-hour, we are also premium, we're also high, we're also expecting price to potentially revert downwards to the equilibrium point or below. We wouldn't mark out this as the high and low yet because price hasn't closed above this high, but we will mark it out and call it basically just the most recent equilibrium. So it's just the we want to keep in mind. So generally, if we're looking at market structure, we're looking at bullish market structure, and we're thinking like if price is going to continue with bullish market structure, it's got to come down before it goes up. Where is it going to come down to before it goes up? So you look at the midpoint, which is here on this orange line, and you look for what are called PD arrays, premium and discount arrays, which are basically things you can see in price that price will react to. It'll bounce off of, or it will return to, it'll react to. So one of those things I've already shown you is a fair value gap. So if we now look at, okay, price is in premium, so it wants to return to discount. Where would it want to return to? So it wants to return to a PD array in discount. So the first PD array I see in discount on the 4-hour chart is this 4-hour gap, fair value gap. So price wants to return there, probably. Obviously this daily fair value gap is above that, so it's obviously needs to return there first. So we'll that would be like the first idea of where price could go, obviously because it has to get there before it gets there. Then there are other PD arrays, like if we look at the previous week, we look at the previous week's close was here, previous week's open was lower, so there's a gap between the week's opens, which you can see more clearly over here. There's a gap here, So we call that the new week opening gap. And as you can see, price like refilled that immediately. Price likes to refill gaps, well, especially new week opening gaps. Yeah, so we're just keeping that there for reference in case we want to see if price could react to it. Then another thing I need to introduce you to is equal lows and equal highs. So if you look at these lows here, this low and these lows, they are not exactly equal, but they are relatively equal. So we call those relative equal lows. If these lows had gone below this low, then they would not be relative equal lows. Relative equal lows, you want the second low, to be higher than the first. And for relative equal highs, like here, you want the second high to be lower than the first high. So the way we use relative equal highs and relative equal lows is we look at it as, first of all, as a magnet. So price wants to return there and run beyond it. So as you can see, price came down and these relative equal highs acted as a magnet, pulled price up, and price ran past these relative equal highs. So first of all, they're a magnet. So these relative equal lows, we can look at them as a magnet to support our idea that price wants to go lower, to run through these relative equal lows. And as you can see, there's another set of relative equal lows here. This low and this low are relatively equal. And then the second way we use them is the same way we look at how when highs are run, price tends to reverse. So that sort of applies even more so with relative equal highs and relative equal lows. So price swept these relative equal highs, and if we start seeing signs of a reversal to the downside, then that theory holds true, that when highs are swept, price will reverse to the downside. When lows are swept, price will reverse to the upside. Whether that's for a long period of time or just temporarily, that's, since we're trading intraday, temporarily is good enough. So we swept this high, we swept equal highs. So a lot of liquidity that is above, which we call buy side liquidity. Buy side liquidity is basically just the invisible liquidity that lies above highs. And sell side liquidity is the liquidity that lies below lows. The reason that there is liquidity there is because people, because there's stop losses there. People put their stop losses at highs and lows. They put orders at highs and lows, which means that if price runs beyond there, a lot of people are going to be knocked out of their positions, which then liquidates the volume they had on back into the market. So like when a high is run, it re-injects volume back into the market, which then big institutions can use to execute large positions which require a large amount of volume or a large amount of liquidity. So the idea is basically if a large institution wants to short, they have, they're placing billions, millions of dollars, so they need a large amount of volume. They need to buy a lot of units of the asset, so they need to make sure that there's no short, because there's a limited amount of volume or liquidity in the market. There's a lot, but there's a limited amount, and the less there is, the longer it takes for them to execute these very large positions. So what they'll do is, before they go short, they'll buy up price to manipulate it to go higher, right? To sweep highs, re-inject volume into the market, so they can then do what they really want to do, which is short now with a high amount of volume, because liquidity has been re-injected into the market. Now they can execute their position more efficiently and quickly to go short. So that's the idea behind why when highs are swept, you want to see price reverse to the downside. When lows are swept, you want to see price reverse to the upside. It's the same thing with shorts. They're going to push price down to sweep relative equal lows where there's going to be a lot of liquidity. There's another story about why there is generally a lot of liquidity beyond relative equal lows and relative equal highs, but that's another story. So they'll push price below relative equal lows. So that's why, first of all, it's a magnet. But once price runs below the liquidity is reinjected into the market, which then can be used to buy more efficiently. So it's a bit complicated, but all you need to know is when highs are swept, generally price is going to reverse temporarily, potentially, and if lows are swept, price is going to reverse to the upside temporarily at least. Okay, so that's the 4 hour. Okay, I'm also going to mark out this little gap here. That's a 4 hour bullish fair value gap. Price has reacted to it. Now I'm going to go to the hourly chart. Each candle is 1 hour. Okay, so first thing I see is price has extended to the upside, and then it's kind of like clustered here. It's sort of become a bit choppy, so that shows a reduction in speed and momentum, which, because we're expecting price is going to reverse after sweeping highs, since we're seeing price quickly run above these highs and then slow down, that indicates maybe price is slowing down, so it can reverse to the downside. So that's something to keep in mind. We've got another set of relative equal lows here, so that's another magnet to bring price down. So we've got a lot of indication that price may want to come down. We do have relative equal highs here though, so we've got to be careful of that. We can look at this little gap which price has reacted to. there's a whole nother story, but bullish fair value gaps, once closed below, can act as what are called inversion fair value gaps. So if we look at this bullish fair value gap over here, price closed below it, so it originally would have acted as a bullish signal, as in price would come down to it, bounce up off of it. But since price is closed below it, you could consider that price may return up to it and bounce down off of it. So it's come up, down, and bounce off of it. Like this. Right, so that's something we can consider in our short narrative. Okay, so that's the hourly. We just look around, see if there's anything else that pops out at us. So this is live, obviously. Doing everything live so you can see that it's done realistically. Yeah, okay. Go down to the 15-minute chart. So this is called top-down analysis, where you start on a high time frame and you go lower and lower and lower to sort of drill down and get an overall picture, and you get a long-term picture, a short-term picture, and you get an overall view of everything, and that puts together your whole idea for your trade. And since you have the whole picture, that helps. So here we have a bearish 15-minute fair value gap, which price has sort of reacted to a bit. Big impulse here, strong fast move. So you can really look at the equilibrium point of really any sort of leg you want. So that's a midpoint of there. So price has returned there, but we can look at this. So this could be a target potentially. Okay, price is a bit rangy. It's gone, up, down, up, down, up, down, and it's failing to make higher highs. It's failing to make lower lows. It's sort of just stuck inside a range like this. It's stuck. So we generally want to be careful about trading in ranges, because price can be unpredictable. It can go either way, so it's lower probability conditions. But we'll look at that. So as you can see, from the higher time frame, we come down and we build this whole narrative, and that's how you come up with your trade idea. So obviously at this point we're definitely thinking we probably do want to short. From everything I've said coming down. Every day is different. Sometimes you might come in today thinking, okay, yeah, I definitely think I want to go long. And sometimes I might even have come down from the monthly to the 15-minute thinking I want to go short, but then I see, okay, maybe before price goes short, which is the ultimate goal, maybe it needs to go up first, and maybe I can participate in that move up and go long. So it's all, you got to be flexible. Okay, so let's see. Okay, we'll go down to the 5-minute. Not really seeing anything too interesting yet. We start trading at 2 o'clock New York time, which is 8 a.m. So we probably want to go short. So the first target would probably be this low. This is the 1-minute chart, which is sometimes where we execute trades. So there were relative equal highs here, which were swept. So I'm thinking that I do want to go short. And maybe price might react off this 15-minute bearish fair value gap, bounce down off of it, and we can take a short to like here or here, or this bullish 15-minute fair value gap. Well, it's actually a inversion fair value gap. So let's see. This is a 5-minute bearish fair value gap. Price reacted off of it, so that's indicating to some degree that does want to go down. Price came up into the 15-minute fair value gap. It did not close above the midpoint, so that's a good bearish indication. If we look at this 5-minute bearish fair value gap, price so reacted to the midpoint. You like to use midpoints of things, so that's interesting. Let's mark out this little gap here and see what that looks like on the 1-minute chart. Okay, so price did close above it, which we don't really like to see. We want to see price respect it, like it did here, like price does here with this gap. But it did come down and then respect it and miss the halfway point and then reject aggressively. So that is a nice indication of bearishness. We like when the midpoint is missed and price reacts aggressively. So I'm thinking like you could potentially look at a short position like that. We should wait till 8 though. So I'll come back at 8 and we'll see how price has developed.